remember one day specifically, I was looking at one of my clients' financial statements. He was probably worth about $30 million. And I also looked at his tax return from the prior year. And I noticed that he paid less in taxes than I did. And keep in mind, at that time, I was worth nothing. I said, okay, all right, clearly I'm on the wrong side of the table here. While it's true that in the transaction business, which I know you know well, whether you're doing loans or you're selling property, you can make a good living. But in that moment, I recognize, wow, the true wealth can only be had owning the assets themselves and participating in the appreciation of those assets and taking advantage of the tax breaks that owning those assets is associated with.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randall. Let's dive in.
You got started 2013. And then you started doing loans. So like what lessons did you learn from the back end, seeing the debt markets that allowed you to go out and buy some of your first assets? Like, let's just start there.
So first of all, thank you for having me, Randall.
Yeah, for sure.
I'm really excited to chat with you and get to know you a little bit better. Really enjoyed looking into your background. So graduated college in 2013. And I got to tell you, I was a little bit of a late bloomer. I was in a lot of ways, physically. I didn't really become a man until maybe my sophomore, junior year of high school. So I feel like my entire life, I've been a little bit of a late bloomer. And that also includes when I was graduating college, I was a little bit of a late bloomer in the sense that I had no clue what I wanted to do. And my grades weren't that great. My internships weren't all that impressive on the resume. And I mean, I mean, 2013 was, I think, an interesting year. I mean, maybe 2013 can be characterized as the year where 2012, things had really bottomed. And then 2013 was the first big rebound year, which we rode that wave for a solid 10 years, right? Until 2022. And ever since 2022, we've been in kind of this difficult environment. So I feel very fortunate that I was graduating in 2013. It was a great time to enter the labor force, but I didn't have a whole lot of opportunities because, again, not a great resume, average grades, not particularly skilled in many things. The one thing I was skilled at, though, was sales. And so I got connected to a commercial mortgage company and very quickly realized that I actually enjoyed cold calling. I don't think there's a lot of people who would say that they enjoy cold calling. There's probably people out there who excel at it, but I actually enjoyed it. I enjoyed this trying to convert a stranger essentially into a client. I enjoyed the game of that. And so fortunately I had some success within the first couple of years and was offered a partnership opportunity. Now, I was offered this partnership opportunity probably before I deserved it. And this is actually a good piece of advice probably for your audience, is that, especially your younger audience, is when you're joining a company at 22, 23 years old, one thing to look for is join a company that is still being run by the baby boomer class, right? The 60 to 75-year-old, cadre of people, but maybe they're missing that generation in the middle. And that was the case for this company I joined. It was all 60 to 75-year-olds and then me at 22. And so I showed some early signs of potential, but they also recognized that they kind of needed to hand me the keys, so to speak, to ensure the success of the company.
Yeah.
So I became a partner quickly. Was doing probably 25 commercial loans a year, anywhere from 800,000 to a million in fees. And so I was living well. Even though I was in California, which means I was paying, upwards of 40 to 45% of my income in taxes. But probably about 7 years ago, there was this epiphany, or really two epiphany moments where, yes, I'm making this really good income. I have plenty of money to do the things that I enjoy. But I had two epiphany moments, one of which was I went into the office one day and I noticed that there was another guy in the office right next to me doing the exact same things that I was doing that day. He was cold calling. He was dealing with a difficult client. He was pitching a deal to a lender. So he was doing really the same activities that I was doing. And at that point, at 25-ish years old, I was enjoying it. But he was 65. And so I kind of remember thinking in that moment, like, okay, I enjoy doing this today, but am I going to enjoy doing this 40 years from now? And the answer was no. So ever since that moment, I kind of, my eyes opened a little bit about, okay, how can I pivot to create a little bit more passive income so that I'm not going to be effectively chained to my desk for the next 40 years. The other thing that happened, and this was in the same year, the cool thing about being in the commercial mortgage industry is that I had access to my clients' financial statements. So I was constantly looking at personal financial statements of very wealthy people worth 25 to $50 million plus, looking at their personal financial statements, looking at their tax returns. Now, I remember one day specifically, I was looking at one of my clients' financial statements. He was probably worth about $30 million. And I also looked at his tax return from the prior year. And I noticed that he paid less in taxes than I did. And keep in mind, at that time, I was worth nothing. I said, okay, all right, clearly I'm on the wrong side of the table here. While it's true that in the transaction business, which I know well, whether you're doing loans or you're selling property, you can make a good living. But in that moment, I recognize, wow, the true wealth can only be had owning the assets themselves and participating in the appreciation of those assets and taking advantage of the tax breaks that owning those assets is associated with.
Yeah, the insight one, I'll take it back all the way from getting the advice you gave. If you're looking for a company to go into, the baby boomers, and then that delta between their age and yours, not only are you getting their experience and learning from somebody who's been through a lot of market cycles, like that's an invaluable experience as well. But then you give yourself the leg up. So I just wanted to comment on that before we went down the other road. And then having the wherewithal and the self-awareness to look around and look at your life in 40 years. That's kind of a benefit as well, to be able to sit back and say, okay, I don't want that. So a couple bits of advice I think anybody can take heed to. So you were doing the loans and you're obviously having a lot of success. How did you decide, or what did you do, I guess, to start buying property? Were you still doing loans and you were still staying active on the active income side?
So the first large commercial deal that I acquired, this was in 2017 again. So I was probably 25, 26 years old. The way that deal really presented itself was I was actually working on the loan for the client, for the guy who was supposed to buy this retail center. And I remember underwriting this retail center, and the rents were really low. The location was gentrifying rapidly. Like this was in Oceanside, California, if you're familiar with that, kind of one of the last coastal areas of Southern California that's still affordable. So he was buying this retail center a couple blocks from the beach. Area is rapidly improving. It's still improving to this day.
Mm-hmm.
Fully leased, but very low rents. Good financing potential, 70% leverage at plus or minus 4%. And I remember like, man, this deal, really good diversified rent roll with all service-based tenants, right? Amazon-proof tenants, a barber shop, a coffee shop, all these things. And I remember I'm underwriting this and I'm like, I really like this deal. But my job is to arrange the financing for my client. But then he ends up canceling. And I'm like, and once I get word of that, I think to myself, I should buy this. And so so that first deal I acquired, I put, $350,000 of my own money. And then I went to my brother, who also happens to be in the real estate industry. And I went to my dad, who also had real estate investments. And they both also put up a third of the equity need. And we bought that. And we still own that asset today. So that was the first deal. And then I want to fast forward to 2020. So 2020 was really the turning point for me in terms of going from the transaction side to the principal side. And what happened in that year was, if you can recall, there was a big event, I think, COVID. Yeah, it's called COVID.
Yeah, that thing.
It changed the world a little bit. And one of my best borrowers at that time was a hotel operator. So he owned a ton of hotels, and I had financed a bunch of his hotels. And COVID hits, and I notice he starts panicking. Right, he is unable to operate his hotels, and he very quickly came to this decision: I don't want to be a hotelier anymore. I want to sell all of my hotels. And on top of that, I have this other business. So he was also a big time franchisee. He was a McDonald's, well, still is a McDonald's franchisee. He's got about 26 locations. So he wants to sell all these hotels, and but he doesn't want to pay the capital gain tax, right? And he's also got all of this cash flow from the operations of his business that he wants to invest into something that will also, appreciate in value. So it was kind of this perfect storm event where I pitched him. I was like, hey, let me help you, because I had done some investment sales as well. So not only was I a commercial mortgage banker, I had quite a bit of experience on the investment sales side. So I made the pitch to him. I said, hey, let me shepherd you through this process of selling all the hotels. And let's do 1031 exchanges, all of the hotels into multifamily, the most bulletproof asset class on the planet, even though, well, as you know, multifamily is in certain markets is troubled right now because it's overbuilt, but it's not like, I don't think that's an indictment on the asset class. I mean, after all, no matter how bad the economy gets, like, people always need a place to live. So he really liked the idea of exchanging out of these very difficult to operate business, which was the hotels, and exchange into multifamily. And then on top of that, I got him to put a lot of fresh, not just exchange capital, but a lot of fresh equity from the operations of his business. So all told, I probably raised from him and one of his other franchisee friends, $25 to $30 million in equity. And so that's translated today to a portfolio that's, plus or minus $90 million.
Yeah. Right at
Um,
70% levered, 65%, something like that. Yeah, sounds about right.
yeah. Hmm.
Yeah, I mean that's fantastic that you were able to position yourself in that way with him to be able to execute that. So in 2020, that's when
Well, I would
you
say our leverage is actually a little bit less because it's the assets have appreciated
okay,
quite a bit.
that
So we
makes
bought, yeah. So
yeah, that makes sense. Yeah, that's fantastic. So you were doing investment sales and you were doing the loans. Man, what was your and I agree. Yeah, multifamily's challenge in certain markets right now. But I looked through your portfolio list of properties here, and most of them look like they're in San Diego. So I'm kind of curious, what was the thesis going into San Diego, right? And buying.
so well, look, and I think sometimes we need to acknowledge when and just be honest when we do something and then it ends up not completely going to plan. And so while I'm still thrilled about what we own and the potential of what we own, um, the original business plan starting in 2020, when we really started ramping up, was okay, let's buy the ugliest building on the street, right?
Yeah.
But in a location. So if you look at, I don't know how well you know San Diego, but pretty much all of our properties are in very desirable pockets of San Diego. They're either coastal locations or they're like, the hipster place to live or where all the tech people are, high earning young people are, where all the cool bars and restaurants are. So that was the business plan. Let's buy the ugly building in the great location. Let's add value over time. Let's slap a new coat of paint on. Let's do new windows. Let's do new landscaping. And then let's also renovate the units as they turn. So let's force appreciation into these assets. Let's drive the rents higher. And then 2 to 3 years down the road, let's do a cash out refinance and recover our equity. Um, so the all and that last part of the business plan has not panned out for
Right.
obvious reasons. We did deliver on the forced appreciation part. Our rents are 30 to 40% higher than when we bought them. The buildings are they do have much better curb appeal. But unfortunately, given what's happened to the debt markets, it's not just that interest rates have gone higher. It's that the participants in commercial lending are fewer.
Mm-hmm.
It's both. We used to have 5 incredible local credit unions, and now pretty much all of them are not lending. And I think this is tied to what we saw with Silicon Valley Bank, and First Republic Bank was huge in our market.
Yeah.
They did every multifamily, and they're gone. Signature Bank, Silicon Valley, First Republic. Um, a lot of the small and regional banks and credit unions are suffering right now.
Yeah.
Because they've lost a lot of their deposits. And so what's unfortunate is that in 2024, if you want a commercial loan, a lot of times you have no choice but to go to Chase Bank and go to the other, to the players who have actually benefited from this turmoil. So I know this isn't a question you asked, but I think it's an important thing to bring up. One of my big concerns with commercial real estate over the short to medium to long term is the fact that there's been this great consolidation in commercial lending, and there's just fewer and fewer capital sources. And I'm worried the big banks will become aware of that and will be less competitive with their terms going forward.
And
Fortunately, when we acquired everything, we got 5 and 7 year fixed money.
Yeah.
So all of our loans are still in the low threes. But but we, hopefully the Fed pivots really soon here because, it's going to be a challenging environment for us if across the board our blended interest rate in our portfolio goes from 3.25 to 6.25.
Yeah, for sure. And that's what a lot of people are seeing that didn't have, like, maybe they had a bridge loan or something. So, I mean, there's a lot in there that I want to ask you about. One, it is a very interesting dynamic that you have with your equity partner and your equity, right? Because uh, having one or two investors with 25 million to 30 million dollars in a deal is a much different conversation than having a syndication with, 50 different investors on any given single asset, right? And so I'm kind of curious, either advice or just like what you how the conversations go with your partners, who may not be IRR driven, or like, hey, we've got to hit this multiple, otherwise you fail. It's like you're kind of in it together and it's tighter knit, is what it sounds like. But I'm kind of curious to get your take on that.
Yeah, I mean, I think that's a long conversation that can be had. Joint ventures versus syndications. There's pros and cons of both. Neither is objectively better or worse, in my opinion. The cool thing about my relationship is there's just so much trust there and rapport that's been developed over years and years and years. Because again, I was financing their hotels before I started working with them as investors. Um, a big reason we were able to grow so quickly was obviously there was a lot of operating cash flow to invest, right? And there was a lot of capital from the 1031s. But the other really key selling point for me was cost segregation.
Yeah.
So if you can recall in 2020, 2021, 2022, all of those years had 100% bonus depreciation. So not only have I gotten them into assets that have appreciated, but also I've saved them seven figures in taxes because they were able to, as joint venture investors rather than LPs in a syndication,
Yep.
they were able to classify as real estate professionals and take these big losses from the properties we bought and offset their income from other sources.
Yeah. I want to touch on that just a little bit because we talked about it
Yeah.
on other episodes, but what you just said is a key distinction. When you are looking to invest in a syndication as a limited partner or a fund as a limited partner, and you earn active income in some form or fashion, and that's all your income, you don't have passive investments that you can attribute some depreciation to, then you don't get all of that bonus. You're not able to capture. You obviously have to talk to your CPA about it, but if you're able to classify yourself as a real estate professional, like I'm a real estate professional, I can take 100% of the depreciation. It's just there's a massive difference. So if you are
Yeah.
in a position where you need depreciation to offset some income, go the joint venture route, or at least pursue and look into it so that you can participate 100% in that depreciation. That's a great point.
Yeah.
Um, yeah, again, man, it just seems like okay. I want to get to the point of where you are now, and like the psychological change. And again, from the outside looking in, it just seems like you had this meteoric rise, right? You've got all these properties, you're buying all these things, which is incredible how fast you were able to go out and execute and buy these assets. To some of the content that I see now that you've put on LinkedIn, to where it's like money isn't everything. Pursue service over the dollar, and the dollars will follow. So, have you always had that mentality, or is that something that has happened in recent years because you're like, well, look, I've seen both sides. I've got the success and I've got the money. It's not everything. Like, what is it?
So Yeah, thank you for so the other thing that I really like to do is produce content myself, and but my content is less video based and more writing based, and actually it's currently an ambition of mine to um actually have that be my profession
Yeah.
is writing. It's something that I really feel passionate about. And the with respect to the question you asked, um, going back to my 9 year mortgage career, I did have very long stretches of my career where I was very self-centered, and all day, when I was at the office, it was the question I would ask myself, okay, who out there, what owner out there can I basically exploit today and extract money from him? For many years, I had that mentality. And if you, as a sales, whether you're in mortgage or you're a real estate agent or any industry, if you have that mentality of what can you do for me, um, your potential success will be capped. And what I found, one of the reasons I was really able to kind of catapult my mortgage career is because I changed my mindset on that. And instead of waking up every morning thinking, how can I make more money for myself? I woke up every morning thinking, how can I add value for other people? And it wasn't just owners, it was the other guys in my office. It was the other people in the adjacent real estate industries. It was the investment salespeople. It was the appraiser. It was the attorney and the CPA and the management company. And it was the owners where I would it's kind of like Gary Vaynerchuk, if you're familiar with him. He wrote a book called Jab, 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 Right Hook.
Yeah, yeah.
And like the more that you just give without any expectation of reciprocity, the more that just like the world conspires to bring that energy back to you in multiples. So it's just something that I've found to be a fundamental truth in life, that if you spend your time focusing on bettering the lives of those around you, that is the path. That is the path to the great wealth and freedom that you yourself are looking for.
I was literally just listening to another podcast, how I made my first million or something like that. I can't remember which one it was, but um, one of the Tony Robbins quotes was dropped in the episode, and the guy was like, "If you're not giving, you're not living. If you're not giving, you're not living." Something like that. I don't know if you've heard that before, but and I was going to
Yeah.
ask you if it was like Go Giver is a book you read, because like that's kind of the philosophy as well in that. But you mentioned that jab, 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 jab. He wanted to call it like jab 1,000 times and then punch. It
Yeah.
was like
Mhm.
his deal on it. So then my question on that front is how do you decide, practically speaking, for real estate professional that's out showing houses, what's a example of something that comes to mind that they could be doing, that they could be giving back or adding value to either their clients or their loan officer or whatever, like.
So, okay, so I think, and I actually have a full, like, I'm not trying to be like a sleazy salesman right now, but I do have like a 4 hour online boot camp on my website that teaches all of this stuff
All right.
about like how do you, yeah, it's all about fast tracking your path to becoming an elite real estate salesperson or mortgage professional. I would say I would share this piece of advice with you, which is if you're a residential or commercial real estate agent or mortgage broker, the first, you really need to be an owner yourself of commercial property as soon, and a lot that goes against, I think, a lot of conventional wisdom that says, okay, just put your head down and just focus on. I disagree with that. I think the moment that you have enough capital to buy something, an investment property yourself, you need to do it. Even if you're buying like, I don't know, a $400,000 strip retail center in Kansas City or something. Like, get something where you can get knowledge as an owner. Figure out what it's like to communicate with a management company. Figure out what it's like to shop for insurance, to get your tax return filed. So figure out what it's truly like to be an owner. And then what you do is, when you are trying to acquire a new client, you don't go to them saying, "Hey, give me your business." You go to them saying, "Hey, I'm not sure what your insurance situation is, but I met this insurance agent, and wow, his level of service is exceptional. He's incredible at what he does. I'm pretty sure he can help you. Would you like me to connect you to? Or, oh, by the way, I've worked with a couple of different property management companies. This company, man, they are exceptional. Maybe you're already happy with your management company, but I think you should." So now because you're an owner yourself, you're thinking in a different way. You're thinking like them, and you're thinking of ways to help them that are outside of your core discipline. And I think if you add value in those ways to them, then eventually they'll bring business to you, if that makes sense.
Yeah, for sure. Yeah. So one aspect of that could be like the connector mentality, where you are making connections. Do you have any other, like, off the top of your head, that are not necessarily connection based, where
Yeah. So just like other ways to add value without
maybe,
well, here's another one. Here's another one that's
yeah.
really good. So I would, when I was a mortgage professional, I would always, the thing, when you're a commercial mortgage professional, one of the items that you always ask for, in addition to a personal financial statement, is a schedule of real estate. And I would talk to the prospect and actually point to a specific loan that they had, and I would say, this loan is incredible. You shouldn't touch this loan. I cannot replace this interest rate. So by doing that, where you're actually actively not pitching your service,
Mm-hmm.
The relationship is strengthened. Same if you're an investment sales broker, you go through the real estate portfolio and you say, "Hey, this property you have right here, like, don't ever sell that. Like, the neighborhood that property's in still has a big tailwind behind it." And so I think doing those types of things gives you credibility for when down the road, you as the mortgage broker, you do point to one loan and you say, "Hey, we need to redo this for XYZ reasons." Or the investment sales broker now has the credibility to say, "Hey, you need to sell that property for reasons X, Y, and Z." Now you have credibility to say that because you previously recommended they do nothing.
Yeah.
So
Commented on that. That's good advice. Solid advice. All right. I'm curious. You've gone through the progression of the lending side, principal side, and now you have a course and you have some things. So, like, what's your main focus right now? Are you still actively going out and acquiring, or have you shifted?
yeah, so we'll probably buy another deal this year, maybe a 5 million or so is what we're looking. So maybe a 15 unit deal somewhere in
Still in
San Diego.
San Diego? Okay. Yeah.
Yeah. So this might be premature to announce, but one of the things that I'm really excited, my newest venture that I intend to launch within the next couple months, is in the funeral home business.
Get out of here.
And I think this is another really, if your audience takes away one thing from this podcast, it would be this, which is, Riches are in the niches. The dirtier the business, the less attractive, the more the business gives you kind of an ick feeling, the better that business probably is. Because the sexy businesses, like, look, becoming a real estate agent or becoming a mortgage professional or opening a restaurant, opening a gym, those are all sexy, fun businesses. The sexier the business, the less I firmly believe the less profit margin there is in that
I mean, it's a
business.
highly competitive. Yeah. It becomes,
Yeah, yeah, and I mean, real estate. The reality is real estate's a sexy business, and so therefore, real estate attracts are the best and brightest in our country, and competition goes up, and commissions and profit margins go down. And so, why the funeral business? Well, my great uncle was in it, my father was in it, I worked in it for a couple of years, and it's really interesting to think about the baby boomer generation. I think there's 60 or 77 million of them. Unfortunately, they're going to start passing away in the next couple of decades. On top of that, you look at the funeral home business as it is today, it's very fragmented. Private equity, people say private equity will own everything someday. Private equity's rolling up dentistries and electricians and plumber, everything.
Mhm.
They haven't made that deep of inroads in the funeral home business. Furthermore, funeral homes are largely owned by baby boomers who are wanting to retire. And the big problem they're faced with is their children have no interest in being the successor. So there was a recent survey that said half of all funeral homeowners, this survey was literally just conducted, half of all funeral homeowners want to sell their business within the next 5 years. And then I looked at the competitive landscape of the brokerages. I mean, how many people graduate college and say, I'm going to be a funeral home broker? Not a lot. And so there's only a few brokerages out there. And same thing with the funeral homes themselves. They're being run by, baby boomers, and there's generally not a next generation. So this is my big idea that I'm working on the business plan, creating the website, and my goal is to launch a national funeral home brokerage. And yeah, so that's the big project I'm working on at the moment, in addition to overseeing all the properties and the education.
Yeah, yeah. No, that's fascinating. All the guys that I know, because I've talked to a number of home owners and operators here in San Antonio, wealthy, like they've done very well. And I don't, one of them, he has owned for years and years and years, like two half finished not mausoleum, but funeral home sites, right? Not the actual cemetery, but just the site where you go and you have the ceremony, and had them for years. And I couldn't figure out why he would just have these things unfinished. And it was like some write off, a loss, a carry forward. I have no idea, but he like, and then I have another guy. So interesting business. There's a few that have traded recently that I've seen, and so I'd be very curious to see like how you price those. Where's the recurring revenue? Is it in maintenance? Because again, grandma just passed away just like a couple months ago, and we went through the whole process of getting a plot. Parents bought plots, and then learning like every time we open this thing, we're going to charge you $1,000, and you want to put something in. So it's just like how are you pricing those things, and are you more interested in owning them and operating them, or in brokering those deals to new buyers?
Only brokering, yeah.
Okay.
Because I do think while the demand for their services is like is definitely a secular growth story given the baby boomers, and then Gen X is a little bit smaller, but then the millennials are even bigger than the baby boomers. So this is, as morbid as it sounds, the business of debt is a growing business. It's another reason why I like investing in medical office, or we have ambitions to invest in assisted living.
Yeah.
But the business of funeral homes specifically doesn't interest me because I do think the margins are coming down because more and more people are opting for cremation instead of burial. So the profit per service is declining. And there's some other headwinds in the business. So, but yeah, I'm solely interested in brokering. And this goes back to talking to your audience about, they might go, oh, start an electrical business or a plumbing business or a roofing. Like they might scoff at that. And I understand it. Like I do as well to a certain extent. But you can do that and you can still do real estate also. Do that as your big cash flow business, and you can still be a real estate person. So it's not like, I feel like people think they're sacrificing their potential of being involved in real estate by going that route, but no, it actually only opens the door because it gives you access to all this capital.
Yep.
To buy properties.
Yeah. Yeah, no, I agree. Having a trade, I did plumbing a lot when I was a kid growing up. My buddy's dad had a plumbing company and we'd all go work for him every summer. And his advice was like, learn a trade and it'll pay you forever. And those businesses and those companies, I mean, there's a reason private equity is going in and gobbling them up, because a service-based business for home services is like never going away. It's not going away. So they're just cash flowing businesses. Well, that's interesting. Again, like didn't know where we would take that as far as the funeral home thing. There was a buddy just in the same complex as me. He's got this thing and he's been going around. The reason I know about it is because he's been going around pitching a lot of funeral homes, a product that he's got. And so we were just talking about that, and then plus the gram. So interesting. I look forward to hearing more about that or seeing what you're working on that front. Hey, Rich, man, it was good having you on the show. I really appreciate you coming on, sharing your content, sharing your information about what you've been working on in your business and what you're seeing for the future. It's been fascinating. So again, thanks for sharing.
Thank you so much for having me.
For sure. Hey guys, we'll catch you on the next episode. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.